Okay, number 8. In 1637, a single flower bulb sold for more money than a house in Amsterdam. Then, within weeks, it was worth less than the pot it grew in. Picture a trader named Jan, not famous, not wealthy, just a merchant who noticed something strange happening in his city. Tulip bulbs, imported from the Ottoman Empire a few decades earlier, had become a status symbol among the Dutch elite. Rare varieties, streaked with unpredictable color patterns caused by a virus nobody understood yet, became the most desired objects in the country. Jan bought a handful of bulbs on credit, expecting to resell them for a profit within weeks. So did his neighbor, so did half his street. Prices didn't rise because tulips became more useful. They rose because everyone believed someone else would pay even more tomorrow. By the peak in early 1637, some single bulbs were reportedly trading for prices historians have compared to the annual income of a skilled craftsman, multiplied several times over. Contracts for bulbs that hadn't even bloomed yet were being bought and sold like paper wealth, changing hands multiple times before a single flower opened. Here's the part almost nobody expects. There wasn't a crash announcement. No single triggering event historians can fully agree on. At one routine bulb auction in February 1637, buyers simply stopped showing up. Within days, prices that had climbed for months collapsed by over 90%. Jan, and thousands like him, were left holding contracts for flowers worth a fraction of what they'd promised to pay. Tulip mania didn't wipe out a nation's economy. Its damage stayed relatively contained to a slice of Dutch traders and merchants, but it left behind something far more valuable than the money it destroyed. The first fully documented case of a financial bubble, driven by nothing but the belief that the price would keep going up because it always had. Every scam on this list, in some way, is a descendant of that same belief. Number 7. Tulip mania was a bubble nobody deliberately engineered. What came nearly 3 centuries later was different. This one had a name behind it, and that name became the word for the entire crime. Charles Ponzi didn't invent the scheme that carries his name. He just perfected the sales pitch, and the sales pitch is the part that still works today. In 1920, Ponzi convinced Boston investors he'd found a legitimate loophole in international postal reply coupons. Buy them cheap in one country, redeem them for more in another. The idea had a sliver of real logic buried in it, just enough to sound plausible to anyone who didn't check the actual math. Early investors were paid extraordinary returns, not from the coupon trade, which barely functioned at the scale he claimed, but from the money new investors kept handing him. Word spread. Lines formed outside his office. At his peak, Ponzi was pulling in roughly $1 million a week, an almost unthinkable sum for 1920. Here's the mechanism worth remembering, because every scheme on this list runs on some version of it. Pay old investors with new investors' money, and as long as new money keeps arriving faster than old money gets withdrawn, the illusion holds. The moment that flow reverses, the entire structure collapses in days, not years. It took journalists at the Boston Post roughly 8 months to expose that the math didn't work, that there weren't nearly enough postal coupons in existence globally to support the returns he was paying. Ponzi was arrested. Investors lost what would be tens of millions of dollars in today's money. He didn't invent the lie. He just proved how fast it could scale. 80 years later, someone would bring that exact same lie to Wall Street, dressed up as a hedge fund. Number 6. Ponzi ran his scheme from a small office with a typewriter. What happened in Germany, nearly a century later, ran through audited financial statements, regulators, and one of the biggest accounting firms on earth. For years, Wirecard was Germany's answer to Silicon Valley, a payments company so trusted it briefly outvalued Deutsche Bank. Then, in June 2020, auditors went looking for 1.9 billion euros the company claimed to hold in trust accounts in the Philippines. The money didn't exist. Wirecard had built its reputation as a cutting-edge fintech company, processing digital payments across dozens of countries. Its stock climbed for years. Analysts recommended it. It joined Germany's prestigious DAX index, a symbol reserved for the country's most trusted public companies. Here's the part almost nobody expected from a company under constant scrutiny. A significant portion of its reported profits was traced to a network of obscure third-party partners in Asia, supposedly handling payments on Wirecard's behalf and generating enormous revenue. Investigators later concluded much of that business, and the cash reserves tied to it, appears to have been largely fabricated. When the missing 1.9 billion euros, roughly $2.1 billion, finally came to light, the stock collapsed by more than 70% within days, and the entire company filed for insolvency inside a single week. Wirecard's chief operating officer disappeared and remains, to this day, one of Europe's most wanted fugitives. The CEO was arrested and later charged with fraud. So how did a company this scrutinized fool an entire national stock exchange for years? This is where the pattern from the first two scams gets an upgrade. Tulip traders were fooled by their own optimism. Ponzi's investors were fooled by a fast-talking salesman. Wirecard fooled trained regulators, professional auditors, and an entire national stock index. Proof that sophistication doesn't protect against fraud. Sometimes it just makes the fraud harder to see. Number 5. Wirecard hid its lie inside spreadsheets nobody could fully verify. The next scam hid its lie inside something almost nobody in the room understood well enough to challenge. Blood chemistry. One drop of blood. That was the promise. A single finger prick that could run hundreds of medical tests instantly without a single needle. Investors valued the company at $9 billion for it. The machine never actually worked. Elizabeth Holmes founded Theranos at 19, dropping out of Stanford to pursue a device she called the Edison, a machine that would supposedly revolutionize blood testing. The pitch was seductive precisely because it targeted something almost everyone fears: needles, hospitals, waiting days for lab results, boards filled with former secretaries of state and retired military generals. Retail pharmacy chains signed partnerships to put Theranos testing stations in stores nationwide. At its peak, the company was valued at around $9 billion, and Holmes herself was described as the youngest self-made female billionaire in the country. Here's what should genuinely unsettle you. The technology, according to later investigations and court testimony, never came close to working as promised. Rather than run tests on the actual proprietary device in many cases, the company reportedly used modified, commercially available machines from other manufacturers, the exact technology it claimed to have made obsolete, while continuing to market the Edison as functional. A 2015 investigative report in the Wall Street Journal began pulling the thread, and the entire structure unraveled from there. Patients had been receiving unreliable medical results, the kind of failure that isn't just a financial loss, but a direct risk to human health. Holmes was ultimately convicted of fraud in 2022. Here's what makes this one different from everything before it. Nobody got scammed chasing a get-rich-quick fantasy. They got scammed chasing hope. The hope that a 19-year-old with enough charisma had actually solved something doctors had struggled with for decades. Belief, once again, did the heavy lifting fraud always needs. Number 4. Theranos took 9 years to fully collapse under its own weight. What happened next took roughly 10 days, and it happened on a technology built specifically to remove the need for trust in the first place. FTX was supposed to be the most trustworthy company in an industry famous for having none. Its founder testified before Congress. It bought Super Bowl ad space, and then, in November 2022, it turned out billions of dollars in customer deposits. Money people believed was simply sitting in their accounts, had quietly been funneled into a separate trading firm the whole time. Sam Bankman-Fried built FTX into one of the largest cryptocurrency exchanges in the world, cultivating an image as crypto's responsible adult, disheveled, unassuming, publicly committed to ethical business practices and philanthropy. Major investors, celebrities, and even government regulators treated him as a stabilizing force in a chaotic industry. Behind that image, prosecutors later established that customer funds deposited on the exchange, an amount estimated by federal prosecutors at roughly $8 billion, had been transferred to Alameda Research, a separate trading firm Bankman-Fried also controlled, and used for risky trades, loans, and lavish spending, all while FTX publicly maintained those funds were secure and separate. Here's the twist that makes this one genuinely different. The unraveling began with nothing more than a leaked balance sheet, showing Alameda's holdings were largely built on FTX's own volatile token. Within roughly 10 days of that report surfacing, a wave of customer withdrawals, a classic bank run, just moving at internet speed, exposed a shortfall that simply wasn't there. FTX filed for bankruptcy. Bankman-Fried was later convicted on multiple counts of fraud and sentenced to 25 years in prison. What makes FTX distinct on this list isn't the amount, it's the speed. Wirecard took years to unravel. FTX took days. Once the first real question was finally asked out loud. In an industry built on the promise of trustless technology, the actual failure point turned out to be exactly what it's always been. A person deciding trust didn't apply to him. Number 3. FTX collapsed at internet speed because crypto markets moved that fast. What happened at Enron took years to build, and it happened at one of the largest, most respected energy companies in America. For 6 straight years, Fortune magazine named Enron America's most innovative company. Its stock hit $90 a share. Within about a year, it was trading for 26 cents, and an estimated $74 billion in shareholder value had simply evaporated. Enron began as a fairly ordinary natural gas company before reinventing itself as an energy trading powerhouse, buying and selling contracts for electricity, gas, and eventually almost anything that could be traded. Its executives were celebrated as visionaries reshaping an entire industry. The core of the fraud lived in something called mark-to-market accounting, combined with a web of off-balance sheet entities. In plain terms, Enron was allowed to record projected future profits from long-term deals as current income the instant a deal was signed, regardless of whether that money would ever actually materialize. crisis. When projections didn't pan out, instead of reporting the loss, executives shuffled failing assets and debt into separate shell entities specifically structured to keep them off Enron's official books. The company looked wildly profitable on paper for years, while actually bleeding cash and debt behind a wall of financial engineering nearly impossible for outside investors to see through. Here's the moment the whole thing actually cracked. When a Fortune journalist simply asked, in print, how exactly Enron made its money, the honest answer turned out to be that almost nobody outside the company could actually explain it. That single simple question began pulling the entire structure apart. The company filed what was then the largest bankruptcy in American history, with roughly $63 billion in assets on the books. Thousands of employees lost their jobs, and, because their retirement savings were heavily concentrated in Enron stock, their pensions along with them. Here's the line that separates Enron from everything before it on this list. This wasn't one rogue founder. It required an entire executive team, and, as later investigations confirmed, the willing cooperation of Arthur Andersen, one of the 5 largest accounting firms in the world, which was ultimately dissolved as a direct result of its role in the scandal. The lie wasn't hidden from the system. Large parts of the system helped write it. Number 2, Enron needed an entire company and an outside accounting firm to keep its lie alive. The next scheme needed almost none of that. It needed one man's reputation, built over decades, and nothing else. Bernie Madoff ran a Ponzi scheme for roughly 20 years. Not months, not a few years, 20. And when it finally collapsed in December 2008, the fabricated account statements he'd sent investors showed a jaw-dropping $65 billion, the largest financial fraud ever traced to a single individual. Madoff wasn't a fringe operator working out of a cramped office. He was a former chairman of the Nasdaq Stock Exchange, a genuinely respected figure on Wall Street, with decades of legitimate credibility behind him. His investment fund promised steady, unusually consistent returns. Not spectacular, just reliably, suspiciously steady, year after year, regardless of what the broader market was doing. That consistency was, in hindsight, the biggest red flag of all. Real markets fluctuate. Madoff's returns barely did. A handful of skeptical analysts, most notably financial fraud investigator Harry Markopolos, spent nearly a decade trying to warn the SEC that the math behind Madoff's returns simply couldn't be real, and were repeatedly dismissed. Here's a detail worth pausing on, because the number itself is more complicated than it first sounds. That $65 billion figure represents the fabricated account balances investors believed they had, the fictional profits Madoff had been reporting on paper for years. The actual cash investors had put in, and genuinely lost, is estimated closer to $17 to $20 billion. Both numbers are staggering, but the gap between them tells you exactly how a Ponzi scheme lies. Not just about where the money went, but about how much of it ever really existed, as anything more than a number on a statement. The mechanism underneath decades of prestige was the same one Charles Ponzi ran nearly 90 years earlier. New investor money paid out as returns to existing investors, with no actual underlying investment strategy generating the profits at all. It only survived as long as it did because Madoff's reputation made the math feel unnecessary to check. The scheme finally collapsed during the 2008 financial crisis, when a wave of investors, spooked by the broader market, tried to withdraw their money simultaneously, and there was nothing there to give them. Madoff confessed to his own sons, who reported him to authorities the next day. He was sentenced to 150 years in prison and died in custody in 2021. 20 years of trust, built specifically so nobody would ever feel the need to check the numbers underneath it. That's not a scheme that succeeded despite scrutiny. It's one engineered, from the very beginning, to make scrutiny feel unnecessary. Number 1. Every scam so far had a face, a founder, a name investigators could arrest, indict, put on trial. What happened in 2008 didn't have one single face, because the fraud wasn't committed by one person. It was committed by an entire financial system, one small, technically legal decision at a time. Nobody signed a document confessing to the 2008 crisis. There was no single Bernie Madoff, no single Charles Ponzi, and yet it destroyed more wealth than every other scam on this list combined. Trillions of dollars in the US alone, and a global recession that cost tens of millions of jobs. Here's the mechanism, stripped down to its simplest form. Banks issued mortgages, including a large number to borrowers who realistically couldn't afford them, then bundled thousands of those mortgages together into complex financial products called mortgage-backed securities. Those securities were then sold to investors worldwide, often carrying top-tier credit ratings from agencies that, in hindsight, badly misjudged, or were financially incentivized not to scrutinize too closely just how risky the underlying loans actually were. As long as home prices kept rising, the entire structure worked because a defaulting borrower could simply sell their home for more than they owed. The system had quietly become dependent on an assumption nobody stress-tested, that national home prices, as a whole, would never fall significantly all at once. Here's exactly where that assumption broke. Starting around 2006 and accelerating through 2007 and 2008, home values dropped, defaults spiked, and the mortgage-backed securities built on top of those loans turned out to be worth a fraction of what they'd been rated. Because those securities had been sold and resold throughout the global financial system, the losses didn't stay contained to one bank or one country. Lehman Brothers, a 158-year-old investment bank, collapsed in September 2008, still the largest bankruptcy filing in American history. Governments worldwide were forced into emergency bailouts to prevent total financial collapse. Here's what makes this the true finale of this list. Every other scam required someone to actively lie. The 2008 crisis mostly required an entire system to collectively decide not to ask an obvious question. What happens if home prices don't keep going up forever? Because everyone involved, from loan officers to rating agencies to investment banks, was being paid based on volume, not on being right. Tulip traders believed a flower would always be worth more tomorrow. The entire global financial system, in 2008, believed almost the exact same thing about a house. The scale changed. The core delusion never did.